What up, Hyperchange? Welcome to another episode. This is the revamped Sippin' and Schemin' podcast. I am so excited to get back on the podcast grind. So it's gonna be a little bit different style content than what you're used to on the YouTube channel, longer form, more casual conversations. I wanna get a ton of guests on this show. So if you know anybody who should be on the show or you wanna be on the show, let me know. Right now, it's just gonna be audio, but I promise I will get the video going for the podcast as well. I'm gonna put this on iTunes, I'm gonna put this on SoundCloud, so make sure to find it there. Anyway, I'm so excited for this first episode of the podcast where I will be discussing why I believe Tesla will raise capital in 2019. You know, the idea of this episode is if I were Tesla's IR team, if I were the CFO, you know, and I could totally control their fiscal strategy and what I thought they should do, this is what my game plan would be. And I think this is an excellent example of just how funny the entire Tesla situation is, where both bulls and bears can disagree on the same factual event and whether it's good or bad for the company. In this particular case, we're talking about Tesla raising capital in 2019 and why I think that's a good thing and something that business should do rather than a sign of desperation. Now, a little bit of context here, you know, all eyes are on profitability for Tesla in Q3 and Q4 of this year because Elon Musk has promised that the company, you know, on Twitter and on conference calls will show GAAP profitability and positive cash flow in those 2 quarters. And, you know, this is a huge change for Tesla, going from burning a ton of money to actually making a ton of money. And so, you know, this has a lot of bulls excited, and a lot of bears, though, have been pointing to the fact that Tesla will only report a profit in these next 2 quarters and then immediately go back to losing money. And I think that is exactly what will happen, but I don't think it's a bad thing. And the crux of this argument of why I believe Tesla should be raising capital and continually investing in growth and losing money on a free cash flow basis right now is because I believe the company needs to invest to build out the capacity to be producing millions of cars down the road. And that requires investing, you know, in new gigafactories, in new production capacity, in new robots, and that is super expensive. And by showing profitability in the near term, you know, and sacrificing these investments in growth, we're actually diminishing the value of our investment in the long term and eroding value to some degree. And that is what's so frustrating with me is as a bull, you know, as someone who loves Tesla and has been invested in the company for so long, you know, my theory is that they actually are creating value by spending money because they're building factories which will allow them to build more cars, which are therefore increasing the intrinsic earnings power of the company, which is the most important backbone of the valuation. So if you believe in Tesla and you believe they're spending money correctly to attack this massive problem of electrifying transport, then you should believe that they should be investing at a breakneck pace to fulfill that mission. Now, this is something that I think is similar to Netflix and what they're doing in a lot of ways, where they're competing in an incredibly capital-intensive industry. You know, they're producing all of this content, which is super expensive, and they are losing billions of dollars of free cash flow per year, and that's not an issue, and you're not seeing it in the media because the company has clearly communicated in their shareholder letters that they will be planning to lose money for years and years as they invest in original content and capture this opportunity. And that is exactly the approach that I believe Tesla should be taking and start posturing to its, you know, investors and shareholders as, hey, look, you know, there's such a big opportunity here. We're growing revenue at nearly 100%. You know, we have a backlog of 400,000 cars. That's almost 15 or $20 billion worth of customer orders that are waiting to get these cars. You know, this is a really good reason to raise money and you know, start expanding as fast as you can to meet this demand. And so that is why I'm a little bit frustrated in the fact that Elon has, you know, set his sights on profitability just to prove something to the short sellers who aren't the investors in Tesla. You know, they don't really care. They're going to constantly spin everything Tesla does as a negative. And in fact, I believe that Elon, by doing this strategy to show profitability for just 2 quarters and then start heavily investing in 2019, which is what I think will happen, and we'll get into the details about that in a second, you know, I just think he's setting himself up to just continue this bearish narrative of saying, the bears are going to say, look, like you squeezed all these higher end Model 3s, the performance version, you know, the dual motor version, just to show a profit one time, and this isn't sustainable, and that's why you're going to lose money. So I don't think showing a profit these next 2 quarters is going to silence the bears. And this is where I think Elon is really sort of off base here is that he believes that the amount of flack and, hate that Tesla's been receiving in the media and the press is due to these short sellers. And why I think that is definitely a part of the story, I think the bigger piece of the story that he's not acknowledging is there's a very valid reason for people to be bearish on, skeptical in Tesla, which is this sort of debacle with Model 3 projections and deadlines. Elon Musk tweeted himself that he thought they would be building 20,000 cars a month of the Model 3 in December 2017. For the entire year of 2017, they just delivered, a little under 3,000 Model 3s. And I'm sure if you're listening to this podcast, you know how many times Tesla's pushed back their production targets for Model 3, but I think that is the big reason there's sort of this bearish sentiment in the media that Tesla has shown, they can't hit their own targets, and then Elon Musk is constantly talking about production hell, making it seem like they have issues, and that is at the heart of the bearish narrative, and it's frustrating because that's distracting from what is really happening with the Model 3, which is that it's been the best-selling electric vehicle in the US for 6 months in a row. It's outselling the number 2 electric car that's not a Tesla, the Chevy Bolt, by 6-1 in June 2018. In terms of competing with internal combustion engine vehicles, it's outselling the BMW 3 Series, the Mercedes C-Class, and this gap is only going to continue to widen. If people were focused on the actual Model 3 sales numbers instead of looking at Tesla's missed targets, I think people would understand why investors are so excited about this company and giving Elon Musk a pass to lose money, because the market share data is proving that Tesla has an incredibly superior product, that customers love it, that they are the reason we are inflecting towards electronic transport. The top 3 best-selling electric cars in the US are all Teslas, the Model 3, S, and X. All this talk about the Tesla killer, etc. Well, Porsche is going to come out with this car that's going to kill Tesla. Jaguar is coming out with the I-Pace. Talk is cheap. I think that is all just a joke. I mean, the GM's Chevy Bolt was the, car that was coming in for half the price with over 200 miles of range. And what is happening to that? It's utterly flopped. And so that is what's going to happen to every other competition. And so I just wish that Elon Musk hadn't made these deadlines so public, and I understand that he's trying to, motivate employees by these really aggressive deadlines, and there is, some merit to that by setting these unrealistic goals, he gets people to work their asses off, and at the end of the day, even if they only get, 80 or 90% of the way to those goals, they've still done the impossible at the end of the day, and I understand that, and so there's just a lot going on here, but I just, at my gut and just at my core, feel like Elon is giving into the short sellers at the expense of Tesla's long-term growth by sacrificing the needed investments in CAPEX to just show profitability. So let me explain here. Let's dive into the numbers and why I believe Tesla not only will raise capital in 2019, but why I just believe this is an incredibly prudent move to do from, a responsible fiscal engineering strategy at the current state in the company's business model. They should be leveraging their very high valuation and share price to sell equity to get more of a cushion for their fiscal situation and to just have more optionality to invest in CAPEX for things like the future Chinese Gigafactory, a future European Gigafactory, and just all sorts of things that they need to do to fund their growth. So I'm looking at Tesla's 10K right now. I'll put a link in the description. Sorry, I said annual report, but I meant the most recent quarterly 10Q filing, because this is actually the most recent up-to-date numbers for Tesla. So taking a look at this, at the end of March 31st, 2018, the end of Q1, Tesla had about $2.7 billion in cash. Now, this is the number to watch every single quarter going forward. What is Tesla's cash balance? Now, historically, Tesla's been burning about $1 billion per quarter of free cash flow to be able to invest in building out the infrastructure for the Model 3. Now, there's a couple things going on here of why that, burning $1 billion quarter seems so crazy and ugly, but why it's about to get better in the near term. The first reason is the biggest driver of Tesla's cash outflow is capital expenditures, known as CAPEX. These are investments that are building out the infrastructure for future production capacity. So they're not actually related to the core current state of the business. They're just basically buying out big robots and building big factories to build cars in the future. And capital expenditures are about $656 million in Q1. So out of the $1 billion of negative cash flow, 65 or 66% of that was related to building out future capacity. So this is a key, point in understanding Tesla, is that the bulk of their cash drain is towards building out future capacity, not towards funding operations. So that's great. But the problem here is that Tesla's gonna continually have to invest in CAPEX throughout the remainder of the year. Now, the company's guided that throughout 2018, they will need to spend $3 billion or so on CAPEX. In the first quarter of this year, they spent about $656 million, as I said. So there's still about $2.3 or $2.4 billion of CAPEX that Tesla will need to spend throughout the remainder of that year. And like I said, Tesla just has $2.7 billion in cash. So if you remove that CAPEX right away, then Tesla is already basically down to zero. And but you might be saying like, oh, well, they're going to start to produce, positive income from operations, positive cash flow from operations. That'll help offset the CAPEX. But there's no matter how you slice it here, they're cutting it so close. And there's an unbelievable article that goes way more in depth on exactly Tesla's cash needs, how they could get to profitability, what levers they're going to need to pull to actually make that happen. That was done by a hyperchanger friend of mine named Meyer. So I'm going to put the link to the description to his article. So if you want to get into the weeds of, what is really happening under the hood with Tesla, you can check that out for more here. But the basic gist is that I believe they're going to lose about another $1 billion in Q2 of this year, bringing their cash balance to around $1.7 billion. And you may say, well, then they're going to start making profits to fund the CAPEX. That'll be enough of a cushion. Maybe, but I'm just not convinced. And at the end of the day, the other big X factor here is that Tesla has a bunch of debt that is going to start coming due here in the near term. Now, in March 2019, they have a big convertible note that if the stock is not around 350 or 360 per share, according to my understanding, they will have to pay out as debt and it won't be convertible to shares. That could be another $1 billion worth of negative cash flow that they're gonna have to take care of. So the point I'm trying to illustrate here on a very high level is that Tesla is like on a shoestring budget here to make everything happen, and there is no room for error. That's why there was so much attention on this Model 3 5,000 a week number, because they said that's what it was going to take for them to get to profitability. And if they couldn't hit that and they couldn't hit profitability, then they were going to be in serious trouble. So this is sort of the frustration to me. Taking a step back, this entire manage your company on a shoestring budget, barely being profitable, barely having enough money in the bank approach just doesn't seem wise to me. We're in year 10 of a bull market right now. The capital markets from time to time will close. And if Tesla, doesn't have a cushion when that happens that they can fall back on and is losing money from their core business, then they're going to be totally screwed. And that is what is so frustrating to me here, is that the market and long-term investors would be totally fine with a capital raise. I mean, we're talking about a couple $1 billion here. An extra $2 billion in Tesla's bank account would be a huge cushion for the company and would make me as a shareholder just feel so much more relief about them not being on a shoestring budget, about them not, forcing deliveries to higher priced ASP Model 3s, which I think is going to backfire incredibly in the long term. And this is, sort of hitting the nail on the head of my frustration, is I believe that Tesla is starting to prioritize Wall Street ahead of customers. And this is totally the opposite of what Tesla's done in the past. This is a sign of a company that's not thinking long-term. They're thinking short-term, quarter to quarter, let's appease Wall Street. I hate that. I think that is a horrible move. And that, to pinpoint this example, on March 31st, 2016, or in March 2016, Tesla unveiled the Model 3. They got hundreds of thousands of pre-orders. And now, 2 years later, at the end of Q2, they still said they had about 420,000 Model 3 orders on the books. Yet then just a week later, they opened up their Model 3 configurator to everyone. So if you want to go order a Model 3, you can literally do it today and not wait in line, and they will prioritize your delivery of a higher priced car ahead of someone who's been waiting for the standard battery, because they'll make a higher margin on that. So therefore, I'm putting the pieces together. What I think is happening is that Tesla is so stressed about being forced to show profitability and cash flow in Q3 and Q4 that they're going to do everything they can to sell higher priced versions of the Model 3, regardless of what point in the line you put down that reservation. Beyond being bad because that's going to piss off customers who've been waiting so long, a huge part of Tesla's strategy, and I think a brilliant piece of their business model that doesn't get enough attention, is this crowdfunding approach where, they unveil a car, collect absurd amounts of deposits. In the Model 3's case, this was almost a $500 million capital injection. $1,000 a pop times 500,000 reservations, if that reservation means nothing because you're just going to skip your somebody's spot in the line because they're paying for too low of an option car, or because the car they want is too low priced, then there's no point in putting the reservation down in the first place. And I think that's a sentiment that Tesla's building up that's going to totally backfire when they unveil the Model Y in early 19, because there's going to be no point in putting down a reservation because the only thing that Tesla's going to care about is delivering the highest price models first. And so I think this is going to backfire, and in the long term really hurts the brand, and this hurts Tesla's relationship with potentially hundreds of thousands of future customers. And I just don't like that. And I feel like that's a consequence of what they're doing here. And so, taking another step back, Jeff Bezos has this fascinating quote that I really has stuck with me, and that I think Tesla needs to think about, which is that, you can hold a rock concert, but you just have to advertise it as a rock concert. You can hold a ballet, but you need to advertise it as a ballet. Where you get into trouble is when you hold a rock concert, but advertise it as a ballet. My point here is that Elon Musk should advertise Tesla, much like Netflix does, as something that will be losing cash flow for years and years to come as they invest in building out this vision for the future. You can't have it both ways. If you're trying to force profitability, then you're breaking this rule of pitching people the ballet long-term vision, but then in the numbers appeasing Wall Street with the rock concert. And that is sacrificing your ability to put money in CAPEX for future factories and, diminishing your future growth rate. And so I think this is a huge mistake for Tesla. And I frankly think one of the reasons that this is happening is because Elon is such a larger than life personality that, the investor relations team, the CFO, and the people in the room on the finance division just don't have enough of a say in meetings to be like, Elon, this is dumb. Let's not promise profitability. We want to build this factory in China. Like, how the hell are they planning on paying for that? You know what I mean? Tesla is spending $3 billion on CAPEX this year to ramp Model 3. In theory, they're going to have to spend somewhere around that ballpark to be able to build out this factory in China over the next couple years. And, there's just so many things Tesla has to spend money on. That the Tesla Semi is supposed to be starting deliveries in 2019. That's 18 months away at a maximum. They haven't even figured out where they're going to build that. They haven't even started working on that. They definitely don't have the money to build out a new production line or facility to build that right now. And so this is just really, really frustrating, because as a long-term investor, I want to see Tesla have a bigger cash cushion, which would make them, way more resilient in a recession. And I want to see them have the flexibility to invest in projects and CAPEX for the future. And they're sacrificing both of those things just to appease short sellers. And this is, I think, a huge, huge mistake in Tesla's fiscal engineering strategy. And to be frank, I've crunched the numbers so many different ways, but the reality of the situation here is there's so much going on with Tesla's financials that we really won't know the power of what they can do with Model 3 and how much cash that will generate till we see the numbers in Q3 and Q4. So I will say there is potentially a chance that Tesla is going to blow away my expectations and frankly everybody's expectations, and will never need to raise capital again because the Model 3 program will be so profitable they can use all that cash plus, a strategically timed Model Y unveiling to fund their CAPEX needs in 2019 for things like the China factory and the Semi production line. So that is possible, but I just think that's so unlikely. And I think Tesla, in their heads is going to be like, okay, we're going to show profitability in Q3, maybe in Q4. After the market likes that, hopefully that juices the stock. Then we will announce that we're going to do an equity offering to build this factory. And then you're going to get a massive backlash in the media about like, well, Tesla said they never needed to raise capital. Tesla said they didn't need to raise debt or equity, but that came with a huge caveat that it was only for 6 months. So that's my thing with Elon and Tesla. If you're gonna have this strategy of we'll show profitability for 2 quarters, but then start spending again, you should say that up front and say we can't be producing permanent positive operating cash flow right now because we're just not a mature company yet. And once we get to that level, we will, but we're not there yet. And it's so frustrating to see Tesla posturing to the short sellers, not its long-term investors. And so I think, is this going to be a deal breaker for Tesla? Is this going to kill the company? No, I don't think so. In the long run, I just think it'll slow down their future growth, which is a bummer. But there is this X factor that if a recession hits in the near term, I think Tesla is absolutely screwed, not because they can't slow down spending on CAPEX, not because the company's being run poorly, but simply because they were just dumb and stubborn and didn't want to have a cushion. And so, And selling $2 billion of equity that you would need to get that cushion at today's valuation of around 50 billion, you're only diluting the company, less than 5%. And part of Tesla's business model, as they've grown and scaled throughout the years, has been to constantly raise a little bit of money with debt, to sell a little bit of equity here and there. And I think that's been really, really smart. And the reason why I'm justifying that that's okay is because if you look at, their vehicle deliveries per share, if you look at their revenue per share, if you look at their gross profit per share, adjusted for all these capital raises, the fundamental earnings power is compounding at like nearly 70% on a per share basis if you go on revenue, despite all these capital raises. So, Tesla's, I don't understand why they're stopping this strategy way too early in their business model. If they were at selling 4 million cars a year and they were looking on steady footing, and then they were like, okay, now we're at that inflection point where we never need to raise capital again, that would make sense. But forcing it for 2 quarters, I don't know. So this is kind of my rant on Tesla. This is the first Sippin' and Schemin' episode. I think they're making a huge, huge mistake here. I would love to know what you guys think in the comments below. Do you think Tesla will raise money in 2019? Do you think they won't need to? Just would love to hear any sort of feedback or comments on that. Anyway, this is Sippin' and Schemin'. I'm going to post this on our SoundCloud, so it'll be on iTunes as well, so you can check it out there. Anyway, I will see you guys next time. If you like Hyperchange, you want to support the podcast, the YouTube channel, definitely check out our Patreon page. I'll put a link in the description there. Anyway, I'll see you guys next time. Peace.